Welcome to the Vaughan Nelson podcast. Today is the second in our Winners and Warnings series, focusing on different industries. And with me today is Deputy CIO, Adam Rich. Welcome, Adam.
Thanks, Dan. Good to be here.
All right, Adam, good to have you back. And so as I mentioned, since this is our second capital allocation framework focused podcast, before we even jump into it, can you give us a quick reminder on what the capital allocation framework is?
Yeah, the capital allocation framework is the process that we use at Vaughan Nelson to help us identify three things. One, help us identify companies that are investing. Two, help us identify companies who can't invest or won't invest. And three, help us to identify industries that have too much capacity and might see lower future returns.
Yeah.
And we have a team dedicated to help us define these three things.
And today we're going to be focusing on the auto industry. Why do you think it matters thinking about industries like autos?
Yeah, and I think what's great about the capital allocation framework is it analyzes companies, industries, and countries. And this is a great example of how we need to analyze how countries allocate capital. About 10 years ago, countries really started to create incentives for the auto industry to start investing in EVs. And this has created for an auto bubble. And it's surprising to me how much this auto bubble has not been discussed in the news, but there are great companies down 50, 60, 70%. And it's really based off of these incentives that countries have created about 10 years ago. And it's created for too much capacity in the industry.
All right, Adam. Well, thank you very much for that overview. So let's just jump right into it. So, first thing here, how has the auto industry's investment approach evolved over the last decade?
Yeah, so about 20 years ago, we had companies like Tesla and BYD really start investing in EV technology. And during that time, they really had first mover advantage for more than a decade. And the reason is a lot of the traditional OEMs didn't really want to invest in EVs. They thought of it as a small market. And to really create an EV platform, it took years of R&D, years of building out the capacity and the supply chain, and probably a decade until you get break-even economics. And so over the past 10 years, we've really seen the change and how traditional OEMs are allocating money. And a lot of that's based off how countries have created the incentives for these companies to start investing in EVs.
So, thinking about kind of where the EV players have come, tell us a little bit about what you found between what separates the early movers from the companies that have come later to electric vehicles.
Yeah, and this is a key advantage. So a lot of the early adopters of EVs had to build out their own supply chains because it just wasn't around. And because of that vertical integration, they do have a cost advantage. And so the early adopters really had to develop their own supply chains, get their own, even down to the raw commodities and lithium in some cases, to be able to really create scale for mass production of EVs and to drop the costs. A lot of the traditional OEM players don't have those same investments and therefore do have higher cost structures, which really separates the two.
Yeah. And then you can't discuss this without talking about China. What role has China played in shaping the direction of the industry?
Yeah, and I think our capital allocation team has played a crucial role in this analysis. And what I think is really interesting about this is if you look at industry R&D and you break it down by region, almost all the growth has come from China. And I think why that's really important because I view the world we're in right now as EV 1.0. EV 2.0 is going to be pretty amazing because we're going to have cars with charge times in 5 minutes, sometimes less in some cases. And all that technology, all that development has really been happening in China. And their technology is just better, and they've been investing in that for 5 to 7 years now.
Okay, so interesting point you bring up. Just contrast that with traditional automakers, right? So why do you think they're finding such a difficult time to adapt to those changes?
Yeah, this is the classic innovator's dilemma. They had a great business. They were protected from external competition in a lot of cases, in a lot of areas, and they really trained their shareholder base that they were going to return capital via share buybacks and dividends. And in order for them to really do those big investments that were needed to compete, they had to take down their margins in order to make those investments, because the ROIs were going to take years for it to really pay off. And so they just didn't make those investments, and now they're stuck because they can't invest in their legacy business, and they can't really put enough investment into EVs to compete with the foreign competitors.
So let's start shifting over to thinking about financing, right? So what do these financing strategies look like? How are the balance sheets affected? Which companies do you think you found can continue to invest?
And this is a key part of our process. It's always really important to find not just the companies who are investing, but the companies who can't or won't. And I think it's really interesting seeing the differences in the capital structure of Chinese competitors and the Western world. I think back in 2020 and 2021, when interest rates really fell, all these automakers, they issued debt. And it was deemed smart because they could term it out very long term at really low rates. But the problem here is their competitors all issued equity during that time frame, and they raised equity and they kept investing, whereas the Western world took those proceeds from the bond issuances and really paid shareholders via dividends and buybacks and didn't invest. And so now that's a problem, because now when rates move up and your low cost debt rolls off, you now have your interest costs going up, which really prohibits you from investing.
So you started talking about a little bit about some policy. What impact has government incentives, subsidies? What do they have had on the industry's growth?
Yeah, they've created a bubble by incentivizing EV production. And we have seen probably, a 20 to 30% increase in auto manufacturing around the world. And I think that is really created for downward pressure for many, many years to come. These things with bubbles, if you go back to the housing bubble in 2008 or the dot-com bubble in 2000, these industries lagged for many, many years. And that's just because there was just too much capacity and you needed years of demand growth to be able to balance it. And I think that's where we're at now with autos. A lot of auto companies haven't done well over the past few years, and there's just too much capacity. And it's because of the incentives that the government's created to help offset the losses for these big EV investments. And now everyone's sitting with uncompetitive EV products compared to Chinese products.
One. All right, Adam. So now, how should we think about measuring innovation, right? And what do you think the pace of change is that we're looking at in autos?
Yeah, this is something that the capital allocation team does. I think it's really important to not just measure R&D and R&D growth, but also pace of innovation. This is something that's really hard for the street and buy side and sell side to really measure, because it is an exponential function, and that's really hard to model. But what we're seeing right now is we're seeing the pace of innovation in China really dwarfing that in the US. And so let me just rewind it a little bit, right? Tesla's business model was built to try to compete with the traditional OEMs. And so they built a model that was faster, quicker than the traditional OEMs. A lot of the Chinese competitors have built their model to beat Tesla. And so their pace is actually a lot faster than Tesla's. And so right now what we're seeing is those big R&D dollars that were equity financed is really starting to pay off, as we're seeing pretty big divergences in the technology stack between Tesla, traditional OEMs, and Chinese competitors.
So, if you're an allocator, you're a client, what lessons should you be taking away from what's taking place in this space today?
Yeah, I think a few things. One, measuring pace of innovation that I just referenced is really important to track. Two, you also have to be mindful of how countries are allocating capital. And here they created incentives to build out production. And then three, I think it's important to measure asset life, right? And so wherever this capital is going, how long do these assets last? And these are 30 to 50-year assets. And so what happens when you've created so much production in a long asset life product is you create depressed valuations, falling ROIs for many years to come. And that is the result of bad policy.
All right, so get to the end of our conversation here. We've talked a lot about the framework. We've talked a lot about the auto market. Okay, so big question. Looking ahead, what does the capital allocation framework? What's it suggest about who's going to emerge as winners? Who might be at risk? We're going to wrap this up with the auto space.
What's amazing about this is this isn't the first time this has happened to us. If you go back to, and when I say us, just to the Western world, when you go back to the 1970s, you had the oil issues that created for really high oil prices, and you had a lot of Western companies who hadn't invested in fuel efficient cars, but Toyota did. And during that time frame, Toyota really did well because they had invested and created cars that had way better fuel efficiency of anyone in the West. And it was a really difficult time for a lot of the Western automakers because they just hadn't made those same investments. And so what's going to happen here over the next 5 years is very similar to what happened back in the 1980s, where you're going to see a lot of consolidation. You're going to see the companies who have made those investments form partnerships to get into markets. And those partnerships are really going to come in and lower the price point for cars. And it's going to really change the auto market in every continent. I also think we're not going to see ROIs improve dramatically until we start seeing capacity being rationalized, which means we're probably going to see some bankruptcies. We've already seen some. We're going to see some EV bankruptcies too. And we're also going to see a lot of mergers amongst the large companies, and we're going to see a lot of brands go away. But again, this is the need to analyze how investments are being made across industries and how it changes. Those are really important to.
All right, Adam, I know I said the last question might be the last one, but one more for you. Thinking through everything we discussed today, any actual items within the portfolios that you've seen so far, anything, how it ties into autos, exposures, anything along those lines?
It's interesting. This is actually research where we were really excited about doing it. We thought we'd be able to find some great opportunities. And at the end of it, we came back and said, you know what? This industry is still not investable. And so we have avoided these industries, and we have generated alpha from avoiding this particular industry because of the overcapacity. But once things are rationalized, we know the companies who are investing, the companies who aren't, and we know who the winners are going to be. It's just a matter of waiting for that right moment until the industry becomes attractive.
Good. All right, Adam. Well, this is really great. Thank you so much for coming on. Really interesting stuff coming out of the Capital Allocation Framework team. So appreciate the insights, and yeah, we're excited to see what they crank out next.
Great. Thanks, Dan. Thanks for having me.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.